Hello, I'm Jonathan Moyes, Head of Investment Research at Wealth Club, and today I'm with Matt Curry of Seneca Partners to talk about the Seneca Growth Capital VCT. Hello Matt, welcome to the studio.
Good
Jonathan. To have you here.
Great to be here.
Could you start by giving us some background to Seneca Partners and your own experience?
Yeah, sure. So Seneca is a specialist northern-based fund management business. We've established a strong presence in the tax advantage space. So our equity funds are focused around the EIS and VCT funds. We tag team that with a strong presence in our IHT proposition. And there's all sorts of other bits and pieces in under the Seneca banner. We've got a significant property investment proposition. And various advisory offerings within the Seneca Group, which overlap to significant degrees within the equity landscape that I spend most of my time in. So I've been with Seneca for 6 years now, heading up our growth capital division. And as I mentioned, that's very much fundamentally our EIS and VCT offerings out there in the market in the tax advantage space. So leading, sourcing and transacting on equity investments in the growth capital space as a whole. Prior to that, I spent a number of years at RBS in their leveraged finance division, focusing on regional private equity deals. And before that, I qualified as an ACA with Deloitte in Manchester also.
So we're here today to talk about the VCT. What does it aim to do for investors?
So we wanted to get into the VCT space really to give investors who'd had success in our EIS funds the ability to access those investments under a slightly different banner. Obviously, they have the ability to access a wider portfolio by coming into a VCT. So what we wanted to do over the initial period is build a diverse portfolio of a blend of public and private businesses across a number of sectors, and really give investors the potential for capital growth alongside an element of tax-free income, which the VCT allows. So we've been paying modest dividends for the initial for the first 3 or 4 years, which, as I mentioned, has given investors the ability to kind of as a middle ground between sort of a pure income play, but also with an exciting, diverse portfolio that has the potential for significant capital growth as well.
So what types of companies are you looking to back?
So as I mentioned, we look for roughly a 50-50 blend of public and private businesses. The key element will always be high growth businesses, very much on that exciting trajectory. Albeit we don't kind of buy into the sort of super aggressive consumer fads and that kind of thing. We're very much focused on some of the more conservative sectors within the growth capital space. We do a lot in life sciences, healthcare, business services, software propositions. That kind of thing is really our sweet spot. Albeit we are a generalist investor, so we look across a number of sectors, and our track record really has been built through picking out pockets of value within each of those sectors and subsectors, and working with management teams to deliver returns in those areas. So that's kind of a broad summary of what we look for. As I say, the general 50-50 split of public and private businesses gives us access to liquidity, but also an element of exciting high growth businesses on the private side as well.
So that's companies on AIM?
Yeah.
That you back? So
so AIM listed businesses. So
can you give us some examples of investments you've made recently in the VCT?
Yeah, so as I mentioned, we do have that 50-50 split of public listed businesses on the AIM market and private businesses. So if I give you a couple of examples of one of each that we've done recently, our most recent AIM listed business that we invested in was a business called North Coders. So this is a technology focused training business. So they do technology boot camps and coding boot camps, and kind of tapping into the significant growth that's been seen in the UK tech scene, albeit with a widely recognised skills gap in that space. Businesses are struggling to to recruit and retain technology focused individuals, and this business is really tapping into that and helping solve that skills gap. So a nice mix of corporate funded schemes, individually funded schemes, apprenticeships, and a great management team that's got a track record of delivering on their business plan. The business IPO'd last year and has probably been one of the more successful IPOs in the last 18 months or so on AIM. So that trajectory is something that we're looking forward to being a part of. Now we're a shareholder in the business.
And a private company example?
So one of the more recent private deals we've done is a business called Alderley Lighthouse Labs, another northern business, a business based just south of Manchester in Cheshire. And this business has been founded by a team that was responsible for managing the COVID testing facilities at Alderley Park in Cheshire. So that, as you can imagine, that facility was of significant scale. So these are experienced individuals in and around the life sciences space that have delivered on a significant project for the government and for the region. In recent times, so it's one we're excited to now be a part of, as that team are looking to build something of substantial scale from a commercial perspective. It's a completely new venture, but delivering on the diagnostic testing side of things, which working alongside their commercial and pharma partners and clients, delivering that back-end testing facility, tapping into the trends of consumers looking to take a little bit more ownership of their own health, get a lot more data and information on what they are currently doing to their bodies and what they should be doing a little bit better, and also an element of corporate well-being, which is a strong trend in the corporate world at the moment. Businesses are very much taking significant interest in the health and well-being of their teams.
Interesting. And so I suppose a strong northern focus in those two examples, is that a feature of the VCT? Is that where you source most of your deals?
So there's certainly a blend. Obviously, the AIM the AIM opportunities that we come across generally come from the London community, but that's not to say that the businesses will be based in London. Quite often they are based around the country. Obviously, giving you an example there of a Manchester-based business, but we do have a strong presence in the regions, which I think is a diversification factor of the Seneca VCT versus some of the more kind of London-centric operators in the space. So it's something that we like to deliver to our investors. I think it's a reason why a lot of them have come to our VCT. So we certainly like to maintain that focus and our presence in the Northwest and the North.
So moving back to the portfolio, are there any particular highlights within the portfolio that you can talk about? Perhaps some of the more mature holdings in the VCT?
Yeah, so one of our holdings has progressed recently over the last 6 months or so to its first in-human clinical trial, which on the biotech life sciences side of things is a significant milestone. So that's a business called SolarScure. It's a wound care business. They essentially harvest, it's an interesting concept, they harvest maggot theory and the enzymes from maggots and dose patients through a hydrogel product on chronic wounds. So it's a very, very underserved and difficult to navigate space of the wound care market. It's traditionally been serviced by either maggots or kind of debriding agents that have had mixed success rates. So this is a product that we're hopeful will deliver an element of debridement in a much more kind of user-friendly, off-the-shelf product. Now that business has progressed to it's now in its fourth cohort of its clinical trial. No safety concerns as yet. So we're hopeful that as the dosage is increased, that safety element will be retained, and we'll see significant signs of cleansing those wounds, which will allows the body to kind of heal itself really. So that's one example in the life sciences space. One of our other private portfolio holdings is a business called Visible. Now this has been in the portfolio since 2019. It's a business that deals with relatively high value enterprise customers looking to innovate and engage and work a lot closer with its supply chain. So this has been the sole focus to date has been primarily on improving capabilities and efficiencies across that supply chain. More recently, they've launched a sustainability module within that platform, which allows businesses to have much more visibility and work more closely with its supply chain when it comes to ESG factors. So from an environmental perspective, that might be kind of emissions focused, or from a social perspective, which is where we're seeing a lot of scrutiny on these types of organisations to allow them to really get under the skin of it, pull the data out of what's going on within their supply chain, and work with those suppliers to improve that element of their business, which, as we all know, is something that they should be doing, and they should be taking much more active role in that as these enterprises. So that business has scaled sort of through just over 3 times since we've been in there, and that's kind of, as I say, predominantly been on the innovation side, and is now very much delivering from a sustainability perspective as well.
Interesting. So besides funding, what do you do to help these companies succeed?
On the private side, as you mentioned, we do work closely with management teams on that front. So that might be the vast majority of businesses in our portfolio. We sit on the board, or kind of sit as observer in some cases, and work with management teams from a strategic perspective. As I mentioned, we are a generalist investor, so we're not the people who will be in and out of these laboratories working in detail on the technology. But where we do add significant value is, as a generalist investor, we probably see a significant amount of deals in comparison to more sector-specific operators. So the volume of deals and the volume of transactions that we're working on are substantial versus a relatively niche operator. So I think what we bring to the table is that generalist strategy, where elements of what's going on in the wider world and the macro economy and the fundraising landscape and the M&A markets is really where we can help drive that strategy. And we support management teams who very much are sector specialists with the tools they need to deliver a successful exit for our investors.
So Matt, you mentioned the macro environment there. It's obviously become a little bit more volatile. How's that affecting the way you invest in your portfolio?
Yeah, I think the number one priority for us in terms of what's changed is probably around cash runway. We've always been relatively conservative in that sense. We always prefer businesses to be fully funded, so we don't get engaged typically in sort of any sort of bridging rounds, or we don't do a significant proportion of pre-IPO rounds, for example, where we're kind of bridging to another transaction. That's not really our bag. So we like businesses to have significant cash runway, and never more so than now. As you mentioned, there will be bumps in the road for these businesses, and it's essential that, I think the key element for us, particularly on AIM as well, actually, is that these businesses are fully funded to deliver on the business plan. Now, you might get to a junction in 18 months' time where things are absolutely flying, and it makes sense to raise further funds because things have moved in the right direction. But what you don't want to be doing is investing in businesses where the likelihood is that these businesses are going to be fundraising again within 12 months, and they're doing so on the back foot, having under-delivered in a macro climate that doesn't facilitate necessarily getting their hands on easy money. So that's probably become more of a focus for us in the current landscape. I think our investment thesis in general lends itself to backing businesses with defensible market positions and a strong offering within their chosen market, particularly where these businesses are delivering on a real need rather than a kind of a desired product or offering. I think where there's a regulatory driver or a substantial reasoning for unlocking those customer conversations, that's where we see our sweet spot anyway. So I think there's an element of it that kind of feeds through really nicely in the current landscape, and allows us to access those offerings at slightly more attractive valuations, to be honest.
So we've seen across stock markets valuations have fallen. Have you felt the need to revalue your portfolio at all?
Yeah, so we are actively monitoring the private portfolio. We're engaged on a regular basis with our investment committee and review very regularly with our independent board from a VCT perspective. So we're particularly where there's kind of milestones or hurdles in that, such as share allotments, that there'll always be an audit trail of how we've come to the valuation of each private business at any of those junctions. So we're all over the private portfolio. There's if I was to run through it now, we're a relatively young portfolio. We've got 9 businesses in the private portfolio. 2 of those have been transacted relatively recently, so kind of had the benefit of reduced evaluations.
One of them's on Wealth Club potentially.
Yeah, and a very good one as well.
Yeah.
So two of those have had the benefit of those reduced valuations on the way in. We've got 7 others in there, 2 of which we have taken the decision to implement a provision against. So they're areas that were likely to be slightly more volatile, where that growth might have slowed. Hence why we took the decision to implement those provisions from a carrying value perspective. Of the other 5, I think it's probably worth touching on the sorts of calculations and the rationale and the discussions that we have with investment committee. So they're generally speaking, to arrive at the valuation of a private business, it'll be affected by an underlying criteria such as revenue or EBITDA and a multiple in comparison to public information, as you touched on. Now, obviously, the multiples have suffered significantly, but we are still seeing significant growth in the underlying metrics. So 3 or 4 of the others, just to touch on, one's gone from 1 million ARR a couple of years ago to 5 million ARR. One's gone from 1 million to just over 3 million. Another's gone from a revenue of 3 million to revenue of 6.3 million, and a very profitable business now generating over £1 million EBITDA. So I think you can sort of get the feel for across the portfolio that there are elements impacting the valuation multiples, but the performance the underlying performance of the portfolio is still extremely strong. So where you might kind of look at an AIM portfolio as suffering from a kind of 30% valuation decrease in the current year, that doesn't necessarily map straight across to the private holdings where they're performing extremely well. But as I say, we are very active in monitoring that. If one was to slow, that's where we've implemented the provisions I touched on earlier.
So what's the biggest challenge you face at the moment?
I think from our VCT and our portfolio in particular, I think the AIM volatility obviously has to be discussed. The underlying businesses that we support on AIM, we're relatively comfortable are progressing in the right direction, but obviously there has been a withdrawal to a certain extent of funds from AIM, and the values have suffered as a result. So I think that volatility hasn't helped in terms of the performance of the wider portfolio, but it's something we obviously went into with our eyes wide open. We like the liquidity on AIM, we like the potential to actively manage our portfolio and trim exposure where businesses have done well. So I'm not sure we can grumble too much when things move slightly in the opposite direction. So that's one element of the portfolio, and then I think as a younger VCT and a slightly smaller portfolio, we've got 20 businesses in the portfolio as we stand today, and I think that we do see a shift when the macro environment gets a little bit more challenging towards these kind of safe haven larger VCTs that have got a much wider portfolio and a diverse spread across kind of 50, 60, 80 portfolio companies within their VCTs. So I think that's probably one element on the fundraising side that we see has kind of stifled a little bit of growth within the fundraising environment as opposed to the portfolio.
Yeah. And so investing in EIS and sort of early stage AIM, it's obviously very risky. How risky would you say it is for a typical investor? How would you describe the risk levels? And is it different for AIM and private?
It certainly is different to an extent. we've been investing in the VCTs a little bit younger, but we've been doing EIS investments for 10, 12 years now, and we've had one failure on AIM, which isn't necessarily uncommon. The vast majority of businesses on AIM are slightly more mature trading businesses that tend to have higher degrees of governance, a wider management team, non-exec and regulatory requirements to police the business and make sure it's running in the right way, which is what we kind of work with management teams to do on the private side, but it's not always the case immediately on day one. So that's probably a key difference, that they generally are more mature businesses. On the private side, where a business, particularly where the fundraising landscape's not particularly attractive, where there's an element of underperformance, it tends to result, or more often than not, it can result in a full write-off of that investment. So I think where we see, and what our track record kind of works towards on a returns perspective, is what we've seen across the portfolio is that you'll have your winners that'll do extremely well, and we target upwards of 3 times return for our good businesses, and we like them to have the potential to deliver more than that. But that's where we see kind of a third of the portfolio. On the bottom end of the portfolio, we probably see roughly a third of businesses within the portfolio that won't go to plan. And then the middle third, which is really where we as a manager earn our money, in terms of businesses that maybe haven't quite delivered, but are still viable businesses, and there is the ability to manufacture an exit from our perspective, and that's where you can see the real kind of differentiator, sort of manoeuvring those businesses from sort of a flat business that's maybe not hit its plan, but is a business that we can kind of get our hands dirty on and help a management team deliver an exit for shareholders. So shifting that middle third from a 1 times return to a 1.5 times return is probably the differentiator between a good manager in this space and an average manager.
Yeah. So how's the VCT performing as a whole?
So the underlying portfolio, as I mentioned, has been performing well. We have obviously been impacted by AIM prices throughout 2022, so that's something to bear in mind. The total return, so the NAV plus accumulated dividends since inception, since Seneca took over as manager in 2018, it is down ever so slightly. So that's something we'll be addressing coming forward into 2023, and it's something we still remain extremely positive on. We've built that diverse portfolio of upwards of 20 portfolio companies. We've hit the target of having a nice mix of public and private businesses, AIM listed businesses across various sectors, which we think gives us a significant level of diversification to deliver on those going forward. So, as I mentioned, impacted in 2022, I think our AIM portfolio is down by 29% in 2022 from a bid price perspective, which is how we value those businesses, versus the wider AIM market, which I think the AIM all share was down 34% over a comparable period. So I think if you take a snapshot now, if we can continue to outperform the AIM all share as the market recovers, I think we'll more than likely have some happy investors, I think.
And dividends, what are you targeting? Can you achieve?
So we targeted initially, when we launched in 2018, 3p a year. That's not changed yet. We always stated we had an aim of increasing that to 5% by 2023. Now, obviously, as we stand today, there's probably a requirement for some exits in the meantime to deliver on that. So whether the macro climate kind of nudges those back or not remains to be seen. But as the portfolio stands today, we're certainly confident of delivering on that 5% within the next kind of 12 to 24 months.
Okay. So to sum up then, Matt, for those that want to invest in a VCT this year, why should they invest in the Seneca Growth Capital VCT?
I think it's for a number of the points we've touched on. We're a relatively young, exciting VCT. We have a regional focus, which is slightly different than a number of other operators in our space. We've built that diverse portfolio of publicly listed businesses on AIM, matched with exciting private businesses, and really now we're satisfied and comfortable that we've got that kind of great kind of stepping stone to launch a substantial scale from where we are today. We've got we've invested substantially from Seneca management team as well. We've got the board of directors, the VCT, and the wider Seneca management team have got upwards of 1.3 million pounds invested in the VCT. So that hopefully that shows the confidence we have in the ability to deliver those returns. So I think as a diversification option and as some of the subtleties we've touched on around building that public and private portfolio with significant potential as we stand today, we're extremely excited about the future for the Seneca VCT.
Matt Curry of Seneca Partners, thank you very much.
Thank you, Jonathan.
If you are watching on YouTube, please press like and subscribe to the channel for more.